Tim Draper, and it's all very exciting. A lot of emerging companies, lots of interesting ways to invest, do very well. And today we have with us a panel of three, one of which should be on Zoom shortly.
What's her name again? What's
Her name is Courtney.
I don't see her yet. Yeah.
Okay. And but I thought in order to start out, rather than me saying hello to everybody, why don't you all give your own introduction?
Hi, so I'm Taimur Sajid. I invest directly in startups as well as in funds, both in real estate, venture capital, and private equity and credit. I'm also I like working with emerging managers, so I support about half a dozen emerging venture capital managers as well as some credit funds. Prior to being a private investor, I was at Blackstone, where I helped launch their residential debt platform. And before that, used to be a quant and a structurer at JP Morgan, where I worked on securitization and equity transactions.
Great.
Hi, everybody. You're probably getting a little tired of me by now. I'm Andrew Hulsh.
Yeah, no, that,
I'm Andrew Hulsh. I'm a member of Mintz. Just joined a few days ago. And my practice focuses on private equity and venture capital. Regarding venture capital, I both form venture capital funds as well as private equity funds, and I represent both sponsors as well as companies in connection with a broad range of venture investments, largely in technology, life sciences, healthcare, and renewable energy. Nice to see you all again.
great, thank you. Courtney, are you with us? Well, okay. Well, let's move on, and we can, hear her introduction in a bit. I was asking the panelists if they had some interesting points that they would like to bring up in particular. And one which Andrew brought up was, I think, particularly of interest to all of us. And that is, it wasn't that long ago that people were climbing all over each other, trying to invest in emerging companies. And as such, the valuations got higher and higher. And of late, let's say early 22, the valuations remained high, but the investment was a bit slower. And so, but founders, of course, still wanted to hold on to their high valuations. So the question is, with this valuation divide has resulted in far less venture money flowing into companies. So the question is, what steps can be taken in terms of structuring new investment to bridge this valuation divide, to find a middle ground to facilitate venture investments?
So I remember last year, let's say January, February, I had 27 active transactions at the same time on behalf of my clients. A number of those transactions were venture investments where, and I was representing several venture funds in different sectors, and they were deploying their capital literally in almost everything they saw. And it was, there was so much competition to make these investments. There were a number of companies that were even pre-revenue that were not necessarily in the life sciences space, which historically is one sector where pre-revenue companies actually do get good funding. But these were in, food and beverage and other companies, other sectors rather, where normally you would think you would want revenues and you would want EBITDA and growth and so forth to justify very high valuations. Nonetheless, deals were getting done left and right, ranging from seed rounds to Series A rounds and even Series B rounds. And of course, life changed a lot bit from my perspective, maybe not for yours. And so, but it is really toxic to founders of companies to do a down round. It gives them sort of a scar that is often hard to recover from, because no investor in an earlier round wants to see that the company has issued shares or other securities in subsequent rounds at a price below the price that they paid for their shares or at a valuation that's lower. And even if they have anti-dilution protection, it's not something that anybody wants to see. People, funds like to be able to see growth in the value of their investments. They like to mark them to market, and they like and need to show their investors that they're actually gaining returns. So at this point, you have this sort of strange situation where lower valuations are warranted, but they don't want to do a down round. So what do you do? Well, one of the things that I have done with my clients is restructure the type of investment. So rather than doing a Series B round, just a straight Series B round with a preferred at a 1-to-1 conversion ratio, you might have a different conversion ratio. You might add warrants or other equity securities or other derivative securities, so that while on its face, it is not a down round, and in fact, on its face, the price per share is often higher. If you kind of peel the onion back a little bit, it is in fact a down round. So yesterday, one of the presenters showed a series of venture investments that were done at. She said there were very few down rounds. And I was very surprised, and I talked with her about it yesterday. And what I think has happened is that these, in fact, while not technically down rounds, I suspect that there are other derivative securities involved to camouflage the fact that they were in substance down rounds. And so, I just urge people from the investor side to really peel back the onion and look critically at how prior investments were structured. Don't just simply look at a price per share paid in another round, but peel the onion back a little bit, see whether any warrants were issued, any other upside in the form of other derivative securities were issued, and really sort of go behind the curtain to better understand what has happened. There are lots of ways of doing this. There are lots of ways of providing benefits to investors who might pay a slightly lower price or a slightly higher price. There are ways of granting new investors a substantial amount of upside in their investments. So that's really the thesis behind that.
Brilliant idea. Do you have anything to add?
Yeah, I mean, so I've been actually taking part in a couple of recapping and restructuring on a couple of companies I've worked with, and yeah, I agree with you that there's still a bit of a disconnect with its founders. The ones that have runway are basically sort of just holding their breath, waiting for their runway to burn out, and then eventually coming to the table. And what I've seen is primarily just it's usually pay for play, where the investors will just basically cram down all the prior investors for Aurora and then recap the team. And also, you will sometimes see some interesting structures where they're incorporating debt and providing like warrants as sweeteners to simulate that effect of equity like returns.
Thank you. Yesterday Tim was talking about the 4 hot topics that.
Evan, you have Courtney already.
Sorry?
Got Courtney already.
Courtney, welcome. So would you mind introducing yourself and tell us a little bit about your business?
Yeah, of course. Thanks for having me. Sorry, I can't see everyone in the room. I'm Courtney Lime-Fuller. I'm a founder and general partner at a venture fund called Springbank. We are an early stage fund, investing typically at the seed, sometimes through to Series A or before in the pre-seed. We have a very specific investment thesis. So we think of ourselves as investing in the infrastructure that we believe can lead to a more equal future, specifically addressing overlooked but large needs of women and families. So we think about those overlooked needs in 3 categories: career, care, and consumer. We back founders of all genders, men and women. We are a typical market rate return fund, and just believe that there's a huge white space opportunity in the kind of social transition moment that we're going through. Thanks for having me.
Oh, so Courtney, we were just discussing, I don't know if you heard this, but we were just talking about that the valuations had been quite high not that long ago. And deal flow has slowed down. So the valuations became lower technically, and it slowed the investors down. We were trying to think of creative ideas, ways to get the investors back into a more aggressive deal flow. Did you have anything to offer with that regard?
I think there's a lot of dry powder. I'm sure we've all talked about this already. So I think they will come back. I actually think there's just not a lot of inventory for investment right now. You know, I think as someone mentioned earlier, if you are a founder with runway at this point, you've taken a lot of efforts to cut your burn and extend runway and not be in the market right now. So, you know, we're still seeing great companies at the very early stages, but we're seeing far fewer really exciting companies. I think anyone who can wait is waiting now. I also think the bar for raising your next round is much higher. You know, what we saw was not only would you have crazy valuations, but someone would announce a Series A and 3 months later they'd announce a Series B. I think at this point, folks realize that the goalposts have pushed out and that you need to show much more actual revenue traction, unit economics, profitability than you had to do, you know, a year, 18 months ago. And so I frankly think a lot of people are in their hole doing the work right now, which is a good thing generally. I think that's a healthier place for us all to be.
So what I was beginning to discuss was, you know, Tim Draper, I don't know if you heard him, Courtney, yesterday. He was talking about his 4 favorite things now as AI, robotics, games, Bitcoin, space, transportation, and healthcare. And I was just wondering if this was deal flow that you were looking at, or was there another arena that you're very excited about of late?
Certainly a lot of overlap on healthcare. We call it even broader than healthcare. We would refer to it in general as the care economy. It's a massive opportunity. I mean, it's, you know, multi-trillion-dollar opportunity if you include healthcare, of course. But there's also just the sort of demographics, right? Of 10,000 people turn 65 every single day. We have huge labor shortages in our paid caregiving workforce, nurses, doctors, et cetera, home health aides, daycare workers. And so there are huge opportunities to think about rebuilding that care infrastructure, not just on the healthcare side, but also childcare, elder care, in-home care. And how do we kind of extend people's healthy living at home, leveraging technology for longer, which we're going to need to do. So that is a huge area that we're interested in. It has really nice counter-cyclical attributes to it, and a lot of really interesting founders who are building in the space. And it has, frankly, fewer, you know, certainly intersects healthcare. But I think one thing we've learned from the cycle in terms of digital health is that at the end of the day, we have huge incumbent players and massive entrenched incentives in the system. And that figuring out how to work within those incentives and to be able to hold, you know, the economic opportunity in one hand, as well as recognizing the kind of regulatory, you know, and potentially public policy implications at the same time, and find the opportunities where those meet has been something we've been spending a lot of time on.
How about you, Taimur? How have you, what particular areas have you found of most interest of late?
So I generally focus within fintech and within prop tech. Within that, I actually focus on capital intensive companies that require a lot of off balance sheet capital, and that's something that's been acutely influenced by the situation with SVB. They were, for a lot of fintech companies, the first warehouse led, you know, provider, and so that's that crunch in credit that's happening is sort of still being felt. We haven't yet seen it influence credit markets for early stage companies or even later stage companies. Just a couple of data points though, like Theorem, which is a company that takes unsecured consumer debt. Their A tranche was priced at a 7.9%, if I'm not mistaken, yield, and which is really high for like their senior tranche. Yeah, I mean, so similarly for prop tech, they are starting to get smarter about how to deploy capital, not using their own balance sheet for acquisitions, but rather sourcing it off balance sheet. So yeah.
I have a quick question for Taimur.
Yes.
So I mean, you're in fintech, and a lot of people like, you know, blockchain involved in
Right.
law. fintech AI. There's been a huge failure with AI and in fintech.
Yeah.
Right? Obviously, especially in prop tech and the real
Right.
estate. It was,
Yep.
Somebody went and they bought a whole bunch of real estate against the recommendation of AI. And I always think, AI, Six Sigma processes are a certain way, but humans are only Two Sigma. And maybe you might want to talk about
Yeah.
kind of clashing between AI recommendations and human instinct.
Yeah, I think that's a good question. It's actually something that, so Open Door is a great example of like Open Door, Zillow, iBuyers in general. A lot of them utilize what we call AVMs, automated valuation models, to price homes. I've actually worked on those as well. And sort of there's a lot of data that goes into that, but it's surprising. And I see this all the time with prop tech founders who have very little real estate experience. They come into the market and they think that these real estate guys, they don't even know how to use a computer, and we'll just, we'll just basically take everything and leave them high and dry. And the exact opposite happens. They get their faces ripped off because a lot of this is so much data in real estate that is not still captured and offline. And so we're constantly like within the real estate space, we're still constantly trying to, aggregate more and more data. But as like Open Door, for example, and all, Zillow's iBuying program can sort of attest to, it's very, very challenging. On the AI side in fintech, there's a lot of regulations that we can't, that prevent, like the FCRA doesn't allow you to utilize sort of black box models for credit decisioning because of potential biases that it might have. That's a big component. There's still avenues of, ways you can use this kind of models, not necessarily on origination and underwriting, but for risk management. But there's this level of, sort of development or embedded AI within fintech and finance is still very, very nascent. We have a long way to go.
Would you like to jump in?
Well, I'll try. With a very big caveat that while I do invest from time to time, my day job is that of a corporate lawyer. So with that caveat, I can tell you what I see, and maybe that's somewhat helpful. So one of the things, there are several categories that I'm seeing, increasing interest in, and a lot of interest at this time. One of them is electric mobility. In fact, one of my clients is saying, Marco, who has an electric motorcycle company. So, certainly electric mobility and battery storage and providing access to power is something that I'm seeing a great deal of right now in terms of investment. Clearly, artificial intelligence is in the front of everybody's mind right now.
Writing contracts.
I think it's scary as hell. I mean, it frightens me when my son turned down a job offer, and he asked me to look at the draft of his letter the other day, and he sent it to me by email, of course. And I read it, and it was incredibly well written. And I said, Jesse, there's no way you wrote this. I said, did you use ChatGPT? He writes back, you hit the nail on the head. And so it is a little scary. AI is scary, and I think people are afraid it's going to replace jobs. And certainly these programs write better than a lot of people that I know. And so the other area that I'm seeing a fair amount of investment in is related to an area that I focus on, which is renewable energy. In venture, of course, renewable energy and buying large wind and solar developments is something that I do in my M&A practice. But of course, it's much too capital intensive for venture. However, there are a number of ancillary services and products that are associated with renewable energy that either enhance efficiency or utilize electric power that's generated from renewable energy. That is a big sort of theme for investors right now, and we're seeing a fair number of companies that are involved in that area as well.
Great. So one question for you, Courtney. Yesterday, Tim, I don't know if you heard this, but he was talking about how when there was the run on that bank in Silicon Valley, that he quickly was able to scoop his money out, which was great for him. But then all of a sudden he realized later that his founders had a lot of money in the banks. Did you run into this issue? And if so, how did you resolve it?
We did. So we had about 40% of our portfolio companies had some exposure to SVB. And within that, it was a mix. Some people had not very much cash and all of it was there, and others had it diversified to among different banks. So they had some. The biggest challenge that a lot of people face near term, besides the sort of existential risk of losing all your money, is they had payroll obviously tied to SVB. And so the risk of not being able to make payroll was incredibly stressful. So, there was really nothing to do, to be honest. It's a bit of wait and see for everyone. The government stepped in on that Friday. And so it's a very nerve-wracking weekend. I think everyone's had a crash course in treasury management since then, which is a good thing. I've also heard some people talking about whether venture rounds want to think about staging the capital. It's not the way when you make an LP commitment, you have a commitment of $5 billion, but it's called over time as the money is needed. And when we invest in companies, you close an $8 million round or an $80 million round, and the money goes in at closing, which if you think about it, maybe doesn't make as much sense. So maybe there'll be some movement on something like that. I kind of doubt it, but it's not the worst idea. And I think, as part of the overall sobering of this environment, we have to realize that these folks are building businesses, they're fiduciaries. They can't lie and go to jail, as we've seen some other stuff. And they also need to be thoughtful about their operations. And that includes the really boring stuff of things like treasury operations.
Taimur, did you run into this at all?
Yes. So I actually worked in JP Morgan's treasury department. So I'm actually pretty familiar with like bank info. And I know the guys at SVB pretty well. I work with them. So over the weekend, a lot of people were just scrambling, just trying to arrange standby facilities for credit. There was a lot of lenders who came out and actually supported the industry. And some folks took an opportunity to be predatory, offering haircuts on deposit claims and stuff. But for the most part, people will do the right thing. In terms of, I think the situation that happened is just like sort of unfortunate. It was really just it's a lot of analysis there, but basically, SVB could have muddled along if there wasn't that flight to depositors that sort of crystallized the liquidity, the mismatch they had. But yeah, I think a couple of things have come out. Like people need to consider cash management a lot more thoroughly, and that's something that I've been telling my portfolio companies for a while now. Is like, just have like a 13-week forecast for your cash flow. A lot of them don't practice this, and they don't even know that they don't have practice. They don't really get educated on basic financial planning, which I think really is on their investors to really educate them and teach them, because they don't necessarily have that skill set. So yeah, I think it's been a sort of educational experience for a lot of folks, I guess.
So, Andrew, do you have anything to add? You've been so creative with your ideas.
So no, I don't really. Other than to say I'm not shocked that this happened with SVB. I think the profile of SVB and lending profile and the lending profile of Signature Bank, and it just didn't shock me when I saw it. When this news came out, I just was not even remotely surprised, because I know how they're involved in deals, and it's certainly a little different than most commercial banks. The approach that they've taken, their involvement in venture investing, is something that enabled SVB to stand out. And it became an institution that a lot of us know very well, whereas 10 years ago nobody knew, and so or very few people knew. So no, I'm just not that surprised. I don't have anything.
They came out of a bank like a lot of us, and I had no idea that anybody that is sophisticated as Roku, for example, would have $480 million in one place. But I guess we're all.
I think Taimur's point was really a good one, which is that in addition to making great widgets, founders need to have the right people on hand to deal with the cash management.
Yeah, I mean, Roku's thing is just blatant. Roku's thing is just blatant. Like their treasurer needs to go, because like they're that's just basic finance when at that size. And at JP, for example, some of the blame also falls to SVB not educating their customers. Like JP Morgan's pretty proactive at telling their corporate clients any non-operating cash needs to go to sweeps because as a GSIB, they get heavily regulated. They get heavily dinged on that, and that's partly due to the SVB explicitly finding themselves or like positioning themselves outside of the broader regulatory, framework that other banks use.
I guess my comment is I don't see it being allowed again.
Oh yeah, I mean, yeah.
The attorney, the regulation, but I just can't see it happening and being allowed to happen again where this amount of deposits is taken on.
I think it was also unique that
Industry.
there was such a massive deposit concentration of like the depositor base. It was like you're not going to see that level of concentration. And then, they I think they're going to roll back some of the
I
regulations.
think the second part of it is that it's amazing how many of these guys are just on automatic pilot, right? We were at another law firm when this happened, and that law firm was pretty prominent in Silicon Valley. We're having nightly meetings about this for 2 hours, all partners on hand talking about how to resolve because it was such automatic pilot that you got $10 million of equity, $3 million loan from SVB.
Yep.
I think, with all the types of money markets and that they would be a little more sensible. But anyway, nobody asked me. So,
The one thing that was concerning, I heard, because I'm like a lot of my portfolio companies come to me because I'm the lending guy, and they got advice from their investors to move their capital out, and they had a line with SVB because that's the sort of thing you deposit, you get preferred terms. They would technically have triggered their covenants by doing so. Some of them actually moved it to personal accounts and stuff, which is like a thing. So it's just I think a lot of education is needed on basic financial, capital management.
so Courtney, are you there?
She just flashed.
Oh, there. Okay, Courtney. How about exits? Have you found that any strategies have changed? And talk a little bit about distributions to LPs.
I'll keep it short. We're a first time fund.
that's
So
okay.
we are not distributing anything yet, but I will make a
Got it.
comment about exits, which is, I do think that the sort of prevalence of strategics in the market has been really interesting across a number of sectors. Certainly always consumer, but also fintech and insurance, certainly healthcare. I think the rise of sort of strategic investors, both with venture arms, innovation teams, and stepping in certainly as exit options is something which has been building considerably the last 10 years. And in spite of what has been kind of a big venture market pullback, we don't actually see corporations pulling back. And I think that's anomalous. I ran corporate strategy and M&A for the New York Stock Exchange for 10 years. I was the CFO of Marsh. We were often the first people out on things like this. And I see that corporations are, very much kind of still in the hunt, very interested in externalizing a lot of the R&D that comes with getting exposure to a venture portfolio, willing partners for pilots, and also, of course, very friendly, exit opportunities for younger companies.
Thank you. Taimur,
I can say that the one thing that's changed notably in the last, say, 14 months is, does relate to exits. 15 months ago, there was a plethora of IPOs, and
yes,
and companies were going public either directly or by merging with SPACs, left and right. I think that the IPO market has slowed down tremendously. I was able to get one company across the line, a biotech company in February, but I also had 4 companies that were in the queue at the SEC a year ago, January, rather 5, and 4 of them did not get across. And so one of the 5 got across the line. So I think exits by going public directly have slowed down tremendously. I think the level of SPAC activity has certainly slowed down from an absolute level of insanity. I remember, I knew it was insane when one SPAC came out that was actually named just another SPAC. And true story. And, but I think as Courtney said, the appetite by strategics and by private equity firms to make acquisitions is still very, very strong. So we're seeing a tremendous amount of activity, whether it's portfolio companies of private equity firms that are looking to build, build through acquisition rather than, or in addition to organic growth, or PE firms just looking to make acquisitions. Obviously in the venture space, a lot of these companies haven't reached a level of maturity that are suitable for primary acquisitions by private equity firms, but certainly a number of them have reached a level of maturity that are suitable acquisition candidates for strategics and for portfolio companies of private equity firms. So we're seeing a lot of that activity, and frankly, we hope it continues.
In terms of strategics, they're very active. I'm seeing them across multiple sectors in finance and energy as well. I think amongst the private equity firms, you're seeing the ones that I talked to, the growth equity side, they're kind of pivoting to sort of looking at taking a more of a distressed approach, where they're basically just taking out the entire cap stack and sort of doing a buyout strategy versus sort of just participating as a minority investor. But their activity is pretty high. Yep.
Yeah. So another question is, I know people say there's a lot of dry powder out there. I mean, tremendous money was raised in the prior years, right? But at the same time, I think that a lot of VCs and private equity firms are really being extremely careful on who they pick to make sure they've got a successful vintage. Because if your vintage isn't successful, you won't raise the next fund. So as you follow 2008, a lot of funds blew up, right? They never raised another fund. They're still on the books as a venture capital. No, I closed that fund. We haven't raised any capital in 5 years, 10 years, right? So most people don't want to end up in that situation. So people who are investing are being very careful. Is that about right, or?
It depends on the timing of when they raised. The guys that raised in 2020, a lot of them, people were deployment periods that I saw were 18 months. It shortened from 3 years to 18 months. So some of them are they're just dead in the water, honestly. But they're just kind of the term I think is zombie VC firms. But there's the ones who were raised later are still have capital, and they're just basically looking from the conversations I've had. They're just looking for the winners to continue to back as they grow. But yeah, I think everyone knows that 2020, 2021 vintages are not going to be great. So yeah.
Courtney, do you have anything to offer?
50% markup.
Yeah, I think those are going to be tough vintages. I agree with that. I think it is a good time to have capital. I do think one of the reasons you are still seeing hesitation, though, is not so much around I'm afraid to invest, or I think a couple months ago there was a sense that you're catching a falling knife and that things are going to get a lot worse from here. I think the summer will be bad. I mean, my sense has been 23 is going to be the fallout year. A lot of companies are trying not to come to market. They don't want to raise. They will run out of runway. They will have to raise as we come into the summer and into the back half. And I think that's when you'll really start to see the pressure. And my sense is a lot of the larger VCs are also holding fire because they realize that they have portfolio companies that are going to need financing and are not going to be able to get it from the sort of open market, if you will. So a lot of it is figuring out reserve strategy and who in my portfolio, is going to need another $50 million, and it's going to be very hard to go and get it. And I need to be ready to write the check myself to kind of keep them going, until they can hit the market again in a couple of years when things are better. So I think that's part of the reason why, despite dry powder, you're also seeing folks hesitate, is they're waiting for this year to shake out and see who they need to rescue in their portfolio.
Interesting. But to that point, are you in a position where you're partnering with your founders and helping them with new ways to navigate and think through the fundraising and a path to profitability? Or is this something you can
of course
share with us?
I think we're all doing that. For us, it's obviously a combination of looking at the plan, figuring out how do you extend runway, how do you really focus on profitability at the expense of growth a little bit if needed. So that's kind of point one. Point two is really thinking about what is the story that you're telling around, the kind of metrics and the next legs of growth. I think that story needs to have a lot more meat on the bones than it used to. And so that's been really important, figuring out who are the pilot partners, what are the proof points, and really thinking about less, let me tell you my $1 billion venture story, and let me tell you, how I'm going to hit the next round of metrics, how I'm going to show you that this can be a profitable business as opposed to just the vision piece. And then the third part goes back again to strategics. My partners and I have a lot of connectivity to corporate world and figuring out, and also public policy and insurance. And so really accelerating the conversations between strategics and young innovative companies, because they're also a source of capital. And for a while, I think venture investors did not like to see strategic money coming in. They worried that they were going to get preferential terms or a first look on an exit. That's just not the case anymore. I think they're really happy to have validation from large incumbents and strategics early in the company's life cycle. So that's been a really interesting avenue to push on more.
Taimur, have you run into this issue?
So on this point of strategics, I think, that they're relatively slow movers. So before, when everything was when rounds were getting done in a week or two, they just couldn't make decisions fast enough. So now they actually have the bandwidth. But a lot of it's just trying to extend runway as much as possible. Look into, in my case, I spent a lot of time helping them get alternative financing, so revenue-based financing, things like that. That's primarily it. Just like part of it's a combination of survive and thrive. First survive, and then after that, once you get to a point where you can, in some cases, reducing headcount, things like that, then trying to figure out ways to lever up without doing it cheaply. So it's a very interesting approach from how things were a couple of years ago, because before it was like we can spend our way to growth.
It's a really exciting time out there, I think. It really is. It was, everything was seemingly so good during the first 2.5 years or 2 years of COVID. And now I think both investors and companies are being forced to think even more critically. I mean, I think they always do, but certainly I think larger private equity firms have always been very, very circumspect about deploying their capital and always conducted very thorough analysis, at least the good ones. Venture funds, I thought were very quick to deploy capital, sort of on the theory that, you make 3 great investments out of 10, and if 7 aren't great, you're still going to do extraordinarily well and you're still going to have a great return. But at this point, because there are some doubts about fundraising, other than at the mega fund level, fundraising for small and mid-sized venture funds and private equity funds, frankly, is a bit challenging right now. So I think as my colleagues on this panel have said, certainly the financial sponsors are being even more circumspect about deploying their capital than they were before. And their portfolio companies, or those that are not yet portfolio companies, are trying to slow down their burn rates so that they can hold on to their capital, the capital that they do have, for a longer period of time. And that's very obvious to me. And yes, it's definitely at the expense of growth, but alternative financing may not be available, or if it is available through on the credit side, it's much more expensive than it has been, over the past 5 years or even longer.
Thank you. So at this point, I thought I'd ask if anybody has some questions. Jesse, you're kind of involved in this arena. Is there anything that comes to mind that you'd like to discuss or
We've got a couple of minutes left.
offer as a question?
So I mean, it's not a question, it's just more from learning perspective. Love to hear people's view on distributions and exit strategies in this market.
So, okay, I guess. So I have a very different perspective than most venture folks. I'm not a venture capitalist. So I come from the world of credit. So I actually like to see as high of a hit rate as possible, and I'm fine with a lower median return. I know that's not what most VCs like to see. They go for you know, 100x returns on at least one portfolio. That's the moneymaker. I think that model is at risk because of just the mortality rate is going to go higher across the board. So I think people that, you know, sort of take that approach, they're kind of at risk of not returning on their funds and having a low, you know, low total return.
Anyone else have a question?
But I just had the last question, which is, you know, what are your thoughts about special purpose vehicles, alternative vehicles to venture that will help kind of bridge this gap period? Because a great example is far fewer healthcare companies are coming to us looking for a Series B, but a lot of our companies are looking for a bridge round to gap the next 18 months. Any thoughts on that?
I'm seeing more of it. Marty, yeah.
You're seeing a lot of bridge rounds, right? Any thoughts?
Yeah, there's tons of them, but I think it's a huge risk. I mean, I just really caution everyone on bridge rounds. I mean, if you're just hoping to kick the can until the conditions in the market are better, I do not think they're going to be better for a long time. I think we've all kind of sobered up across the spectrum. So continuing to fund, you know, and have a company be undercapitalized, I think is a massive risk. So I would be very cautious of bridge rounds. I'm sorry, I missed the intro, so I don't know what your name is, but the attorney who's on the panel with me, you know, you were really talking about sort of strong efforts to disguise things so that it doesn't look like a down round. And I think some of those incentives are really there. And I think if you're the kind of sucker who steps in to fund a bridge on the terms of the last round so that everyone looks good and the company can take the can 9 months, I think there's a lot of risk in that market right now.
You were going to
No, I think we're good. I think we're done. And
already have anything else to offer? Okay.
thank you, everybody.